This episode is sponsored by moomoo to help you learn your options strategy as a beginner. I know that some of you really love to pick individual stocks despite me advocating about investing in the index funds and ETFs. And some of you wait for your individual stocks to fall, but it seems to never fall below the level that you're willing to buy. So in today's video, I'll share about a beginner's option strategy where you could wait for your stock to fall to your ideal price before you entering, and you get paid while waiting for it. But for disclaimer first, this is definitely not financial advice, and options is a high risk, high reward strategy. So for beginners who are learning to start options, make sure that you have enough funds set aside for your savings account and also your 6 months of emergency funds before you embark on this kind of risky option trades. So let's take for example, your favorite stock is Apple, ticker AAPL. And you know that Apple right now is around $150. That's one share of Apple at $150. But what if you want to buy 100 units of Apple? There will be 100 units times 150, that is $15,000, right? And then some of you may think that $150 for Apple is too high, it's too overvalued. Maybe your ideal price to enter into Apple is at $130. So how can you then use options for you to enter Apple at $130? Of course, I'm not saying that you can manipulate the stock price of Apple to fall to $130. We are not God, right? But I'm going to teach you about an option strategy known as cash secured put. I know there are a lot of options experts out there, but bear with me here. Today, I'm just going to introduce about cash secured put, about how you can actually enter at a lower target price that you desire. So for those beginners out here who don't really know what is options about, you can think of options like a contract. So you're buying or selling a contract depending on which side you're on. And on this side of the contract, there is a put option or a call option. Okay, so for a put option, it is the right to sell contract, which means that if you have bought this contract, you have the right to sell this stock at this price. Okay, that is for the buy side. And if you are the sell side, which means that you sell a put option, that means you are selling the buyer of this option the rights to sell Apple at this stock price at the expiry date. To put it very simply, right now the current Apple stock price is around $150 as of recording date. And if you sold that put contract option to the buyer, you're giving the options buyer the rights to sell Apple at the stock price of $130 by the expiry date. And I'll go through this in a more detailed example. Let's use the sponsor of the day, your moomoo SG app. If you scroll to moomoo and search AAPL, which is our stock ticker that we are interested in, just click on the options chain. And on this options chain, you can see many different expiry dates, and you can see whether it's a put option or a call option. So we'll select the put option chain, and for the expiry date, let's hypothetically select 30th of December. And for your information, most of your options contract will expire on Friday. And each contract is worth 100 units. So if you do not intend to purchase or sell 100 units, then options is not for you. So hypothetically, we are targeting the ideal stock price of Apple to be $130 before we enter, right? So we choose $130. And your expiry date, maybe you want to put it at 30th December. And hypothetically, the put option contract is now worth $2. So if you sold this put option contract, how much would you get back? That is $2 times 100 units, and that is $200. Once again, because you're selling this contract, that's why you're gaining money back. Because you're selling this contract to the buyer is paying you $2 for the contract, and because it's 100 units, you get $200. And of course, this is assuming that you put in a limit order instead of a market order, because for market order, it will just take the market price, whereas for limit order, you can set in the price that you are willing to accept. And for the hypothetical reasons, I will set it at $2. So you as a seller of this option, you gain $200 for this option that you have sold to the put buyer. But let's not forget that there will be commission for every trade that you do, because even for options, like you buy stocks, you need to pay commission, right? And options, you need to pay around $1 to $3 of commission depending on which trading platform you're on. But for moomoo SG, if you sign up using my exclusive link and sign up for your moomoo account, you can get commission-free trades even on your options trade, which is valid for 30 days. And it's not some normal moomoo referral link, it's this exclusive options link, which will then give you this commission-free options trade for 30 days. So now you receive $200, you think you're happy, right? Like that, free money, or keep churning. But life is not that simple, because there's an expiry date, you see, at 30th December, the Friday. 3 scenarios will happen, which is the OTM, ATM, and ITM. And I'll go through what each of them means, right? Starting with OTM. which means out of the money. Out of the money means that the buyer who had bought the options contract is losing the money. It's out of money for the options buyer. But you know, out of money for options buyer means what? It's good for the seller. What? Means the seller earn money. For example, on 30th December, for an OTM scenario, it means that your current price is higher than the strike price. Example, Apple is at $140 on 30th December. That is $10 higher than your original strike price at $130, right? Maybe you see the market slightly dipping because right now Apple is at 150, maybe fall to 140. But 140 is still higher than your $130 strike price, which means the options contract is out of the money for the buyer, but it's good for you as a seller because it means that right now your options buyer will not exercise this put contract because he could have sold Apple at $140. Why would he exercise the contract, which is the right to sell Apple at $130? He must be out of his mind, right, if he's exercising that contract. So you see, out of the money is good for people who have sold a put options contract. Also means that when you are selling a put, you are actually doing a bullish strategy because you expect the market to go above your strike price. So it's a bullish strategy. Now let's take a look at the second scenario, which is at the money. Now in a scenario of at the money, your options will actually decay over time. That's called the time decay or theta. And you know, by the expiry date, if it's at the money, it means that the options hold no more value anymore because maybe your strike price is the same as the current market price, and that is the time where your put option actually expire worthless. Your buyer will not exercise the contract, where you as a seller will actually gain because you see, you actually pocketed the $200 upfront, right? That's when you sold the put contract, and then you see your buyer did not exercise it even though the market is flat because there's no difference between the options contract price versus the current market price. So most likely the options buyer will not execute the right to sell, which is good news for you as a seller. So you see, in these two scenarios, as a puts options seller, you have already benefited from OTM and ATM because the buyer did not exercise his right to sell. Now let's take a look at the last scenario, which is ITM, in the money. So it means in the money for the options buyer, which is good for them because most probably at in the money, that's when your buyer of the put option contract will profit, which also means that probably Apple this time has fallen to below $130 strike price, maybe at $120 level. That's when your options buyer can actually exercise his contract, which is the right to sell Apple to you at $130 despite the current market price at $120. It means that the options buyer has benefited $10 for each Apple stock that he has sold to you, because that is $120 versus $130 of gain. That is $10 difference, and multiply that by 100 units, that's 100 times 10, which is $1,000 gain. So it's in the money for the options buyer, not in the money for you as a seller. It's always in the buyer's perspective. But does it really mean that you lose money? Not really so, because you have already intended to buy Apple at $130 strike price, and because you have already pocketed $2 of premium previously when you sold that put option contract, it means that your exercise price is $130 minus the $2 of premium. That is $128 of entry level price that you have entered into Apple. But just that now the current market price is $120, you're buying it at $128. So in order for you to secure this put option contract, you will need to have 13,000 US dollars. That is to buy 100 units of Apple at $130, right? But remember, because you have $200 upfront from selling the options contract, that means you only need $12,800 coming out. Now what happens if you do not have that 13,000 after the expiry? Then most likely the broker will make you go on leverage or margin, which means that they have to charge you interest because you did not have enough cash inside your trading platform to execute the trade, which is not preferred because leverage and margin trading is quite dangerous, and some of you may get into margin call if you are too addicted into this kind of easy money. But the moral of the story is that you should always have enough cash to secure that put option should your put option be exercised by the expiry, and also on the basis that you really want to own the stock. Make sure it's really a good stock that you want to own if the put option is exercised. Otherwise, if you sold put option contracts on some stupid stocks that you don't want to own, maybe you will be back holding a few of these stocks. But on the other hand, if you realize that your cash secured put is always out of the money, which means that for every put you sold is always expiring worthless, you can keep generating that premium, right? It's like recurring. But don't expect it to be 100% successful, because I mean, if you can get 7 winning trades out of 10, I think it's good enough already. Once again, option strategy is highly risky. It's not recommended for beginners. It's after you have done a few demo trades, maybe you use some paper trading account, then you are comfortable with how options work, then you can start to use your own money. Otherwise, I think it's very risky for a beginner to just jump in their options and do all these kind of advanced option strategies that they may not know what they're landing themselves into. So word of advice here, maybe try out a paper trading or demo account first before you really execute on the trade. Once again, if you are interested in using this cash secure put option strategy, make sure to sign up for a moomoo Singapore account using my options referral link, because it will give you commissions free trades on options for up to 30 days. And also a tiny little bit of platform fees do apply, so it's not like totally zero fees out of pocket. But don't worry about moomoo if you're worried about the security, because this is SIPC insured and also registered with the Monetary Authority of Singapore. So it's not like those cryptocurrency platforms where it's really not regulated by authorities and really no control over customer funds. And if you want to check out an earlier options video that I did, which is far more advanced, then check out this video right here where I did a bull put spread strategy.